Hello and welcome to this week's edition of Invest Africa. I'm Alicia Second. Well, Africa's financial services industry has experienced strong growth in recent years. The financial services industry on the continent has the potential to unlock Africa's growth story and further encourage investor confidence. Let's take a look at this report.
Africa has come of age and can now compete with the rest of the world. According to tax and advisory firm KPMG, financial services sector can unlock Africa's untapped growth potential. This due to a growing consumer market with an estimated spending power of $1 trillion. Although Africa's financial services industry has experienced strong growth in recent years, due to the ongoing global financial crisis and its impact on Africa, a large percentage is not included in the formal financial system.
Africa's economies were significantly adversely affected by the 2008 global financial crisis and even the global economic recession that followed. And so there is a resilience that is evident in the continent, not just in South Africa. However, regulatory pressure is really quite ubiquitous. We're not going to escape it, whether it is Basel III or tightening of how banks operate gradually in the continent. It is happening.
According to Standard Bank analyst Simon Fremantle, only 25% of the population in Zambia has access to banking or other formal financial services, while in Nigeria, 80% of the population either access finance through informal means such as mobile banking or not at all. Even in South Africa, the continent's most developed economy, 1/4 of the population lack access to financial services. Africa's financial services industry's ability to contribute to powering Africa's economy is at the consumer level. The future for banks in Africa is said to lie in retail.
We need to find ways of regaining the customer trust, the confidence that customers have in banks. That needs to be rebuilt. And we are also seeing things like, for example, the most trusted brands in the world today are Apple and Google instead of people trusting their banks.
Although formal financial sectors may limit households' access to basic financial services, retail banking considers everyone, from a low-scale enterprise to a large-scale enterprise. Africa's financial services industry has proven to be one of Africa's key economic components as it creates an environment for growth.
Let's get into some analysis of the evolution we're seeing in the financial services space on the continent right now with Minos Gerakaris, who's head of trade finance at RMB, and Chris Hart, chief strategist at Investment Solutions. Welcome to both of you, gentlemen. Thanks so much for joining us today. Let's, Chris, start off with you. What are you making of the kind of evolution we're seeing within the financial services space? Because, of course, it's domestic activity that's begging for the service, but also Africa's role within the global context as we see trade deals coming more and more to the fore.
One of the things is that the financial services is still quite fragmented, and in each country there's a different stage of development. And one of the things is that there's a huge lack of deep and wide capital markets, whether it's stock markets or equity markets. So a lot of your financing activities sometimes gets done outside the continent, in other words through your Japanese or European banking systems rather than in Africa. So there's quite a lot of potential to move business onto the onshore, as it were. But there still is quite a bit of development that needs to take place in terms of capital markets and money markets and that kind of thing, so that you can actually consolidate the pools of capital, that they're not as fragmented, to move it from under the mattress, as it were, and outside from how could you say, hidden sources where you've got financial repression and you've got capital that's actually, you could say, escaped the system because of things like exchange control and that kind of thing, and that is actually held outside the country, the individual countries. That needs to still be brought back in a sense. So one needs to still see quite a bit of liberalisation that to take place.
Minos, bottom line, you've got urbanisation and the demographic dividend. That's part of the appeal, trade and trade finance as well. Give us a sense from the perspective you have of the kind of activity that's enticing investors right now, because just this week Standard Chartered making headlines that it's expanding operations in South Africa specifically, and that to chase business opportunities as they see private businesses explore explore more aggressively on the continent?
Indeed, Alicia. I think it's largely been a sector that hasn't had a huge amount of focus, in that banking largely across the continent was quite lazy and was taking in retail deposits and essentially just lending it back to the government in T-bills or short-term bonds. So very lazy armchair banking, and banking wasn't driving the growth in a number of these economies that it should have been done. There's huge potential for that now, and a lot of requirement for local funding to drive infrastructure, to drive growth, to drive development, to lend to the commercial sector as a whole. And this is what's making the banking sector exciting to indigenous banks to expand, as well as foreign banks coming into the market.
Let's take a look, Chris, at how the appeal is translating into actual investment here, because we've had our big four right here in South Africa moving aggressively in order to make their presence more felt on the African continent. What's your assessment of the playing field? Because certainly those global players being awakened as well.
Well, I would prefer to use the word an assertive African expansion program, because it's still very cautious, and one needs to be understandably so, because each country has its own pitfalls. One needs to understand it before one actually just goes in. There's been many, when it's not necessarily in banking, but certainly many misadventures where South African companies have blasted forth and actually have had their fingers burnt. And so one needs to appreciate that while there's huge potential, and I think, as you say, the shift away from armchair banking as the internal demand, as your homegrown African corporate starts to flourish, as you've got in Nigeria and Kenya and Ghana, etc. It's no longer just tiny little businesses that really just need a deposit facility and a sort of transaction facility. You now need greater trade facilities, and the greater demand for people who are actually embedded in the economy rather than something that's based externally. And that's why I think you've got the elements for the financial services sector to take off. There's other areas that still need to be developed, asset management and pension funds, for instance. Something is huge development that still needs to take place, that's still very embryonic.
But we are seeing traction. Minas, whatever strategy you choose, it's no easy feat. I mean, FirstRand experiencing the political difficulties of investment in Africa. It's embarked on things with an acquisitive strategy. It thought it had acquired, for example, Finance Bank, only to have the deal jettisoned by Michael Satters and his new government in 2011. Things taking a while to conclude over in Ghana with Merchant Bank as well, where the new president there is not a fan of that deal and how it's at play. I mean, it's that political risk that comes with doing business on the continent that's highlighted even more so.
Yeah, but I think you've really got to look at it as expansion's not a short-term solution. When a firm's taking a decision to enter a market, it's for the long term, and it's about a sustainable growth path in a specific jurisdiction. So whilst there may be challenges in certain markets, and particularly in the startup phase, one must never lose sight of the end goal, and that is to be a regional financial services provider. And I think the strategy's long changed with the majority of financial institutions, from one of just following your customers, and you've looked at the big retailers and some of the miners, etc., as they've expanded, looking to service just that small niche, to going in as a full-service domestic bank. Yeah. So when you enter Nigeria, you enter as a Nigerian bank. Same in Tanzania, Mozambique, Ghana, wherever. And it's looking to bank the population in country, bank the commercial interests in country, and then look at strategic corridor flows, particularly in the South-South trade zones at the moment, which is really driving growth. If you look at the strategies that are currently at play, and if we're looking at the big four South African banks as examples here, they've all embarked on the growth story in Africa with different strategies. We've got Standard Bank organically doing things, but then with the muscle of ICBC helping it along. Yes. You've got FirstRand looking to pursue its growth acquisitively, Nedbank joint venture with EcoBank, and then ABSA with its partnership and parent company Barclays, or that partnership as it's evolved. Which one works best for you, do you think? Well, to my mind, each country is a unique
opportunity? Is there an acquisition opportunity, or greenfields or brownfields opportunity, or partnership? And I think each needs to be taken, on those merits. I don't think there's any one sort of solution, and that's always the problem when we speak, is it's Africa as a single brush. As I say, you certainly wouldn't treat North Africa the same as Sub-Saharan Africa as a general divide. You certainly wouldn't choose, have the same strategy in, say, Senegal as, or even a Francophone African country as opposed to an Anglophone, or even a country which has still got very rudimentary financial services industry. Let's say Burundi, for instance, is very different to Ghana, as it were, and that's why one really does need to actually do one homework in the sense that Nigeria is already a market that's got established banks. In that you'd probably prefer to do an acquisition there, but in a country like Tanzania, you may prefer to do a standard bank approach.
It's also often, driven by local regulation. If you did want to be in retail banking in Nigeria, there are no new licenses to be issued. And in a number of other jurisdictions, there's going to be less banks rather than more, as regulators look to build a safer, more secure banking system and drive consolidation through raising minimum capital. So in those markets, then acquisition becomes the only viable entry proposition.
The only lesson that one needs to learn from the first Rand experience is that the regulatory environment is not stable because it's connected with the political
So let's take a look at that, because we've touched on the political environment and now regulatory environment. There are concerns about regulatory reform, and then there are concerns about political interference. And some quarters suggest that intrusion by governments in banking is now a fact of life, be it in the form of tougher regulation, new taxes, nationalization. How do you draw a distinction between the two? Can you?
You can, and I think one needs to understand that when you've got a stable regulatory platform, it doesn't actually matter what happens at the ballot box. You can be in business regardless, etc. The new guys may come in and say, we're going to tweak this or change this or whatever, but your actual basic ability to be in businesses is not changed. Where you actually say, the new guys say, oh, we actually don't think you should be in business, etc. That kind of thing is been Africa's curse, if you like. I can remember being at a conference once, and the finance minister was speaking on the platform, and he's very enthusiastic. We are a place that we open for business, come and invest. And people said, but when we do this, we experience these hassles. And then he said, phone me directly and I'll sort you. And I said, that's exactly why we don't want to invest in you, because we depend on individuals to unlock or lock, etc. And so you find sometimes the players in the economy use the politicians as as their leverage to actually poke a stick in the eye of their competitors. And so that instability is something where you get stronger platforms, where you've got good elections taking place, for instance, is probably your best clue as to whether you're getting what I call the constitutional stability, where you actually things are taking place within a constitutional framework. And that's where the safest is. Where you've got still dodgy elections or coups, etc., it's probably
to mitigate against some of the challenges, some of the risk. Emphasis naturally being placed on strong, efficient, transparent regulatory systems. Minas, the South African banking system, for example, has been pretty well shielded, largely due to tight regulation, good governance, and being well capitalized. Yet, worldwide, regulatory oversight continues to be one of the top concerns that faces the financial services sector. Warranted, one would assume, where it's given the turmoil that we've seen. It's a lack of regulatory oversight that's actually triggered it all.
No, I disagree with you. It's the one sector that's the most regulated. When people say lack of regulation, I'm saying maybe inappropriate regulation, but my gosh, it's the most regulated sector, so that's where the problems came in. Maybe it's because of the regulations that are these constantly competing intrusions that create a lot of the problems.
Do you agree with that, Minas?
Absolutely. As a regulated person, we are always regulated, and the regulation is always evolving. I think comparing the global financial crisis and having that as a lack of regulation, or as having that as people finding regulatory arbitrages and possibly using those to create problems, is a completely different debate. But there's certainly sufficient regulation, and we see in the African continent using these learnings to build a more robust banking system.
Well, one of the countries that has done that, Chris, has been Nigeria. It clamped down on things very aggressively back in 2010. We had the new central bank agenda cleaning things up in a big way. What's your assessment of that playing field right now, post-crisis? You already alluded to it when you compared it to Tanzania.
No, exactly. It's a fairly, to my mind, if you look across the African continent, you'd say South Africa's got a good banking system, and then you'd immediately think Nigeria is the other, big banking player where it's an established industry, but it's gone through quite a lot of turmoil itself. I think in a sense they've tried to get rid of the fly-by-night, so that's to help to clean the industry up a bit, and so I think in there they've achieved quite a bit of success. Okay, but I think one's also got to be careful if you get what I call the fascist kind of economic model, where you're starting to intrude into the boardroom to actually make decisions, business decisions, as remote control, where you don't have to have the consequences of those decisions, but you're still making those decisions, forced lending, that kind of thing that can take place. So that's always a fear. Likewise in pension funds, do you just use it as a pot to plunder when you're a little bit short of cash as the government, which is why you don't develop the actual industry, and it's a major important source of capital formation.
Well, we're going to have to hit pause on the conversation for now. Certainly the Nigerian banking crisis that did unfold was relatively short-term. If you look at the kind of long-term impact it managed to have on sentiment towards the Nigerian banking sector as a whole. We're taking a quick commercial break right now, but there's more on Invest Africa when we return, so stay tuned.